Welcome to this masterclass on option Greeks. In this video, we will break down the essential metrics used by traders to manage risk, focusing on delta, gamma, theta, and vega. Understanding these is key to moving beyond basic trading and mastering your market exposure. Why do the Greeks matter? They are the language of option risk. They tell you how your trade will react to changes in price direction, the passage of time, and shifting market volatility. Without this knowledge, you are trading blind. Here is a quick overview of the four primary Greeks. Delta measures price sensitivity to stock movement. Gamma shows how that delta changes. Theta quantifies time decay, and Vega tracks sensitivity to changes in implied volatility. This is our roadmap for the masterclass. We will take a deep dive into each Greek, examine how they function within a position, and finally distinguish between intrinsic and extrinsic value. Let's begin with Module 01, Delta. This is your primary measure of directional sensitivity in an option contract. Delta, defined. It predicts how much an option's price will change for every $1 move in the underlying stock. It is the most critical risk number for any trader to monitor first. Think of delta as a speed dial. A high delta means your option reacts strongly to stock movement, while a low delta means it barely reacts. A higher sensitivity leads to a significantly different outcome for your P&L. When we visualize delta for call options, we look at the slope of the curve. As the stock price increases, the value of the call rises. The steeper that curve, the higher the delta, and the greater the sensitivity. Call options carry positive delta. This means that if the underlying stock price rises, the call price rises as well. They move in the same direction. Here is a worked example. With a delta of positive 0.50, a $1 rise in the stock price typically increases the call price by 50 cents. Conversely, a $1 drop results in a 50-cent loss. Now, let's look at put options. They carry negative delta. This indicates that the put price moves in the opposite direction of the stock price. When visualizing puts, the curve trends downward. As the stock price falls, the put gains value. This is why puts are commonly used as a hedge against falling prices. Delta has a defined range. Calls range from 0 to positive 1, while puts range from 0 to negative 1. An option cannot be more sensitive than the stock it tracks, which is why the delta is capped at 1.0. Consider an Apple 135 call. If its delta is 0.47, the market expects a 47-cent move in the call for every $1 change in Apple's stock price. Let's watch how that prediction holds up. When the stock moved up by $4, our Apple call moved up by about $2. This reflects the 0.47 delta in action, proving how accurate these estimates can be for tracking real-world performance. Traders also read delta as a rough proxy for the probability that an option finishes in the money at expiration. A 0.20 delta suggests a 20% chance, while a 0.90 delta indicates a 90% chance of finishing ITM. Low delta, near zero, means a small chance of becoming shares and weak reactivity to stock moves. High delta, near 1, means a high chance of becoming shares, moving nearly dollar for dollar like the stock itself. To summarize, delta is the expected price change for a $1 stock move. Higher absolute delta means more sensitivity. It also doubles as a probability estimate, though remember it is dynamic and changes as price moves. Moving on to Module 02, Gamma. If delta is the speed of your trade, gamma is the acceleration. It is the Greek that measures how your delta drifts over time. Gamma estimates how an option's delta will change for a $1 move in the stock. If delta is your speed, gamma is the rate of change in that speed. Delta is not fixed. As the stock moves, your delta drifts. A call that starts as a 0.50 delta can shift to 0.65 as the stock rises. Gamma is the metric that measures this shift. Think of it this way. Delta predicts the change in option price for a $1 move. Gamma predicts the change in that delta for the same move. They are two layers of the same directional sensitivity. Let's look at an example. A call with a 0.50 delta and 0.05 gamma. If the stock rises by $1, your delta moves to 0.55. If the stock falls by $1, it moves to 0.45. For calls, when the stock moves up, delta rises, making your option more sensitive. When the stock moves down, delta falls, reducing sensitivity. Gains can accelerate in your favor as price trends upward. Gamma works similarly for puts, pushing delta toward minus 1.0 or toward 0. As the stock falls, put delta moves toward negative 1, becoming more sensitive, while a rising stock pushes put delta toward 0, making it less sensitive. Returning to our Apple call example, we saw it begin with a 0.50 delta. As the price climbed, the delta moved to 1.00. The call started behaving exactly like the underlying shares themselves. Why does this happen? Deep in the money, an option is almost certain to be exercised. Since it is poised to turn into 100 shares, it naturally trades with the same sensitivity as those shares, pushing its delta toward 1.0. You can also read gamma as a change in probability. As price pushes toward the strike, the odds of finishing in the money increase. Gamma tracks how quickly those odds improve, reflecting the rising sensitivity of the option. To wrap up Module 02, gamma measures how much delta changes per dollar of stock move. It acts as the acceleration for delta, where rising prices increase call sensitivity and falling prices impact put sensitivity differently. Next, we will cover Module 03, Theta. This Greek explores the cost of time and how the clock itself influences your option's value. Let's begin Module 03 with Theta. Theta predicts how much an option's value decreases each day, assuming the stock price and volatility remain constant. It's essentially the daily cost of holding an option as time runs out. To visualize time decay, imagine holding a 90-day, $200 strike call. If the stock and volatility are frozen, the call's value will gradually slide from $8 towards zero as expiration nears. Theta is the slope of this slide, which steepens as you get closer to expiration. Why do options decay? An option price is a bet on future value. As time passes, there is less opportunity for the stock to make a big move. With less time for a large payoff, the option's market price inevitably drops. Theta is quoted as a daily value. A theta of negative 0.04 means you can expect the option to lose roughly 4 cents of value every day, all else being equal. Remember, time is the one variable that only moves in one direction. Crucially, time decay is not linear. It is relatively gentle when expiration is far off, but the decay accelerates significantly as you enter the final stretch. In those last few days, the option's value can drop off a cliff. To summarize theta, it represents the expected daily price loss due to time. It assumes other factors stay constant, and it acts as a constant headwind for buyers because decay accelerates rapidly as expiration approaches. Now, let's move to Module 04, Vega. While delta tracks price and theta tracks time, Vega is all about your sensitivity to changes in implied volatility. Vega measures how much an option's price changes for every 1% shift in implied volatility. It tracks the market's expectation of future movement, essentially gauging how stormy traders expect the stock to become. Implied volatility is the market's forecast of future price movement. If traders pay higher prices for options, it implies they expect bigger stock swings, which increases implied volatility. Vega connects those expectations directly to the price you pay. Consider two calls on identical stocks with the same expiration. If one costs $5 and the other $10, the gap is likely due to implied volatility. The more expensive call reflects a market anticipating larger price moves. Here is a practical example. If you hold a Tesla call with a Vega of 0.31, then a 1% increase in implied volatility should theoretically boost your option price by 31 cents, even if the stock price hasn't moved. Higher implied volatility inflates the price of all options, whether they are calls or puts. When the market expects bigger swings, the potential for a large payoff increases, and the market prices that risk into the option premium. Conversely, when expectations calm down, implied volatility falls and options deflate. The range of likely outcomes shrinks, and the premium built into the option price decreases accordingly. In this simulation, we hold everything constant except for volatility. You can see how shifting from 20% to 30% volatility lifts the entire price curve. This is why buying low and selling high in volatility can be so profitable. To wrap up our masterclass, remember that Vega measures price sensitivity to volatility. It means your P&L can shift even when the stock price is flat. Mastering the balance of buying low IV and selling high IV is the key to professional volatility trading. Welcome to Module 5. In this section, we cover position Greeks. This is where we learn how to summarize your entire trading book into just 4 key numbers. Until now, we've looked at Greeks for individual options. Now, we'll roll these up to the position level, showing you how your entire setup responds to market movements using delta, gamma, theta, and vega. Here is an example of a real position summary. You can see its complete risk profile defined by these 4 specific values. Let's break down delta and gamma. A positive delta means your position gains value as the stock rises. Gamma tells us how that delta value itself shifts when the stock moves. Next, consider theta and vega. Theta represents the daily value lost as time passes, while vega shows how much your position gains or loses based on changes in implied volatility. You might wonder why we use numbers like 175 for delta. This is due to the contract multiplier. Since each option controls 100 shares, the quoted price is effectively multiplied by 100. Because of this multiplier, even a small 50-cent move in the listed price results in a tangible $50 gain on the contract. This translates directly to the position delta reading. When you scale up to 5 contracts, your position delta stacks accordingly. In this case, 0.50 delta across 5 contracts gives you a total position delta of plus 250. Moving to Module 6, we'll examine the difference between intrinsic and extrinsic value. Understanding this distinction reveals exactly what time and volatility can actually affect. An options premium is split into two pieces: intrinsic value, which is its current in-the-money worth, and extrinsic value, which is the layer built on time and uncertainty. Importantly, Theta and Vega only influence the extrinsic layer. Time decay melts this layer away, and volatility causes it to expand or shrink, but they cannot reach the underlying intrinsic value. Intrinsic value is truly untouchable. For a 135 strike call with the stock at 150, the $15 of intrinsic value is locked in and cannot be erased by time or volatility changes. This chart summarizes which Greeks touch which value type. As you can see, Theta and Vega specifically act only on the extrinsic value. Use this cheat sheet as a recap of how the Greeks measure price, time, and volatility across calls and puts. Always read these factors before you execute a trade. Master the Greeks, and you master your risk. By understanding direction, acceleration, time, and volatility, you now have the tools to read the market more effectively.